Good afternoon, everybody, and welcome to this edition of ThinkTechnical for 2nd of March. My name is Carl Capilingua. I'm the market analyst over at Think Markets, and it is a pleasure to be with you as we delve into everything technical, everything chart-related for the next 10 or 15 minutes or so. Before we do that, let's talk about the Think Markets difference, which is substantial. $8 flat rate trades, your own holder identification number, unlimited phone support, and of course no hidden platform or subscription fees. 4 fantastic reasons to make sure your next ASX share trade is with Think Markets. The agenda for today is to have a look at the big picture first. Those are macroeconomic factors that are moving markets at the moment. Plenty going on in markets right now. Then we'll bring it closer to home, see what's going on with the local market, and have a look at a few ASX stocks of interest. I'd like to kick off today looking at a comparison of bond yields and stocks. And, if you would have to have been hiding under a rock for the last week or so if you haven't heard on the media this problem of rising bond yields and the impact it has had on stocks. And we've seen stocks weaker over the last couple of weeks, and they've had a little bit of bounce back over the last couple of days. But what's it all about? What's going on here? So rising bond yields can often be a problem for stocks, for stock markets in general, because bonds are considered to be, and when we're talking about government bonds here generally, considered to be risk-free assets. So as the yield on those risk-free assets rise, they become more competitive against the yield on stocks, which are far from risk-free assets. It's possible that the company you invest in goes bankrupt tomorrow. It's pretty unlikely that the US government, for example, is going to go bankrupt tomorrow. So rising bond yields hurt stocks from a relative yield basis. Another way rising bond yields hurts stocks is through lower profits. So obviously when yields go up, a lot of borrowing rates are set based upon those long-term bond yields. And for companies who have debt, the cost of servicing those debts go up. Also, for us consumers, our borrowing costs tend to go up as well. We have less to consume, and that could also negatively impact company profits. And the other big factor for stocks is these rising bond yields are often used to peg what we call the risk-free rate or the discount rate when it comes to evaluating valuations for shares. Obviously, if you have a higher valuation on a share, or as an analyst, you can evaluate a higher value on a share, there's more scope for your clients to pay higher prices to buy those shares. If you can only accommodate a very low valuation on those shares, there's less scope for that to occur. And that risk-free rate feeds into what we often use in the industry. It's called a discounted cash flow analysis, where we discount the future values of cash flows coming into a company, into a business, back to a present value. Long story short, if the interest rate you're using to discount those cash flows is higher, the value of those cash flows today is going to be lower, and therefore you can only support a lower valuation for the company. And vice versa, if the discount cash flow rate is lower, then you can support a higher valuation for companies. Of course, discount rates are on the rise, so we can only therefore support lower rates of valuation for companies. Now, all of that gets turned on its head when you sort of try and understand why rates are rising. Rates are rising because of higher inflation expectations, but inflation expectations are rising because of higher growth and the stimulus that central banks and governments are throwing at the global economy. So that's a positive as well. And as markets, we're trying to balance this out, aren't we? We're trying to balance out the positives of higher growth ahead, which should mean higher corporate profits, against these higher bond yields. And you throw that all together and you get the ructions of the last few days. So hopefully that just helps you understand what's going on and maybe soothes your nerves a little bit. Let's have a look at history and what history says about rising bond yields. So if we go back to around about 2000 here on this chart, we're looking at the US government bonds, 10-year government bonds more specifically, the yield on those versus the S&P 500. So that's the benchmark index in the US. And we can see the blue line, which is the US 10-year yields, and the orange line, which is the S&P 500. And we're looking at percentage changes. And we're looking at percentage changes on each. It's not so important what the level of the change is. We're more concerned about what the shape is and how one can impact the other. Okay, so typically when the yields are rising, we can look at a period 3, and I might start drawing on my chart. So we look at a period 3 here, where bond yields are rising. We'd see it corresponds with a rising stock market. In fact, it was really sort of once yields started to head back down again that the stock market really had that dip, GFC dip. And then we actually had a pretty sharp rise in yields as we were coming out of the GFC. Very similar circumstances to now, where markets were beaten down, the global economy taken a huge hit from the GFC, and government central banks threw a lot of stimulus at the global economy, and we saw bond yields spike up as a result, but that was a precursor for growth. And again, the stock market took off and took off and took off again. There was another little rise through here, I guess. That was what we call the taper tantrum. Very similar again to what's happening now, where yields spiked, but once again on high growth expectations, the stock market rallied. And then we had another one here where Trump was elected, and of course the expectation there was he would be a very stimulus-orientated president, and the stock market took off again. So what we can see is that rising bond yields aren't necessarily bad for the market. In fact, more often than not, rising bond yields are a precursor for economic growth, which is good for corporate profits, and shares tend to go up. The problem occurs when there's this initial adjustment where yields rise very quickly, and to put it into perspective, that's where we are right now. So we actually haven't gone up all that much compared to some of the big moves we've had in the past, and we're seeing a little dip on stocks, probably not even showing up there, even on that chart. And the problem right now is we don't know how high these bond yields are going to go before we find a level where they settle down, and markets will settle down, and stocks should, I think, go higher again. As promised, let's head over to the charts of some of those yields. I might put myself back in the corner over here for a second, and we're having a look at the Australian 10-year bonds to start off with, and we'd see what a huge rise they've had just in a very short space of time. So really from February, they started off around about 1% and then got to just shy of 2%. So if you imagine the Reserve Bank delivering to the market 4 consecutive 25 basis point interest rate increases over the course of a month, it would be a major, major shock for the market. So it's no surprise that shares have had some struggles over the last month, because that's what market rates have done. It's largely to do, as I said before, with those inflation expectations, and inflation expectations are close to sort of 2 to 2.5%. But again, that's nothing to panic about, because our Reserve Bank has said that's pretty much where they want to get inflation, and the Federal Reserve has said that as well. So when you look at how far they've come and where inflation expectations are now, it's hard to see these yields going much higher than that. If anything, they may pull back a little bit. And the overshoot probably is to do more with short covering and people just being caught on the wrong side of that bond trade, which was a very popular trade for a very long period of time, as rates were continuing lower and risk, relatively speaking, were high, and bonds tend to do well when risks are high. Having a look at the US 10 years, what's interesting here is they didn't go up as much as Australia. So the Australian economic growth seems to be viewed as being stronger going forward by the markets, but still topping out at 1.6 and back down to 1.4 now. That's giving the stock market cause to rally a little bit. Whilst we're here, because this is a certain database I have to use to display these items, and then I have to go to a different database to talk about the Australian stuff, let's have a quick look at China iron ore, which is still looking very strong at the moment. It is supported by that view that economic growth is coming, lots of infrastructure spend, lots of growth down the track, and that is supporting iron ore prices. We're seeing a short-term uptrend, a long-term uptrend. Nothing in the chart that would suggest that uptrend can't continue for the time being. Yes, the price action is becoming a little bit more compressed, and I'm watching that. By that I mean, this is where price action is expanding nicely, and we get into this consolidation phase. But that's pretty natural after you've had a big run, so not too concerned about that one. Support at 1090 and resistance at 1202. And of course, we're talking about yuan per tonne here, and this is the benchmark May contract in China. Whilst we're here, we'll have a look at crude oil. So these are, indicators of global growth going forward, aren't they? Or proxies for growth. So crude oil, great uptrend, short-term uptrend, long-term uptrend in place. Nothing sinister there to suggest that our base case still isn't in play, and that is, the growth is more likely to be coming than not. Might have a quick look at Bitcoin. We haven't looked at that one for a while, and I think the last time we looked at it was around about that sort of 28,000 mark maybe, and it was on the way up. I gave you a target of 40,000. Then since then I've been on Ausbiz and other media outlets. I've called 50,000. We did get there, and now once that's breached, we're still in this trend. You have to look upstairs, and it could be 60, it could be 70, and we'll keep an eye on the trends, I guess, to determine what it might be. But for now, the short-term trend is a little mixed. We can see we've gone from rising moving averages to flattening moving averages. So a little bit of caution required there, but overall the long-term trend is still very strong. We're holding this key support level here at about 42,000. We had a little swing low here at about 43. And as long as that 43, 42 level holds, I can't see why the trend can't continue to the upside. Would I be a buyer right here and right now? Probably not. I think a little bit more consolidation might be required in this zone. So if we can get another little swing low here higher than 43, maybe it might be 45 or 46, and then the next breakthrough 50 would be more interesting than probably going just after this first pullback here. So I guess if we could draw it, we might want to see and imagine in this area here. We want to see something like this pattern here. So we've at the moment we've sort of come up, come down, and we're here at the moment, and something like this, or even just a little building pattern in here, and you'd be looking to go on the break of, say, that peak there, which, give or take, if that scenario plays out, is probably going to be around about 50,000 or 50,500. Switching databases and switching gears, we're over here on the Nasdaq Composite. Things were looking a little hairy there. Might zoom in a little bit as bond yields were spiking, but as bond yields have come off a little bit, we've seen a little bit of a rally here. I think quite a lot of damage is done, so I think I'm more on the cautious side than the optimistic side for the Nasdaq, just in the very short term. Certainly, if we can get back above these short-term moving averages very quickly, and we know that the moving averages are supportive, but we just haven't challenged them this much, really, since September last year. And we could see something very similar to this. So if you look at what happened in September, we came down, we tried to get back above that level, and it wasn't until we saw that pattern I talked about on Bitcoin that we're hoping to see there, that sort of W shape, that we got some more confidence coming back into the market. So it'd be interesting to see what happens here. Do we continue for a little bit further and maybe make some higher peaks and troughs and then go then? That's yet to be seen. But we're not in this sort of clear-cut phase where you're in a nice trend. For example, here you're pulling back, you get a nice price action signal, and then it's just a trend continuation situation. We've broken that short-term trend, and we need to be a little bit more cautious as a result. Long-term support isn't until 12.074. I hope we don't get down there. We might just have a quick squeeze at the Shanghai Composite. This one was looking amazing as it came back from Chinese New Year celebrations, but then once again caught up in those rising bond yields. It has also pulled back to below its short-term support zone, which we do know is an area where the price has bounced back from before. I think the fact that we're here so quickly after the last one is concerning, and therefore I think you want to be a little bit more conservative for that reason as well. Long-term trends on this and the Nasdaq remain up, and we're just using these as proxies for global equities more than anything else. They're very risk-on markets, and I think when you assess both of those, you would say that we are hardly green light risk on at this stage. All right, well, let's bring it a little closer to home and have a look at the ASX 200 index. We didn't see the gains of the Nasdaq and the Shanghai Composite, so that straight away starts to give you cause to doubt the underlying strength within the Australian market, at least over the last few months. I mean, we have been in this very tight trading range from sort of 6,500 to 6,800. We did break to the upside on the positivity in broader global markets, but really could not bottle it and take it through to the next level. We should have got to those old highs, I believe. And the fact the market hasn't done what I thought it was going to do is a little concerning in itself. We are struggling at those short-term moving averages, and whilst the long-term trend is up, and I'm bigger picture bullish, I think we'd still need to do a little bit of time here, and once again we'll be looking for those price action signals. We have got a nice little trough set in here, which is constructive, but again, until you see this sort of pattern coming in again, I think you need to be a little bit cautious in the meantime. Okay, we'll have a quick look at the sectors and then a few stocks of interest. The discretionary sector first. Have a look at the short-term trend. The short-term trend is telling you what's going on. It's been an area of great support, and we are beneath that now. And whilst we're beneath that, I think you need to be cautious. I know I'm sounding like a broken record here, but I'm just reading what I can see in the price action. The price action is pretty flat at the moment on the energy sector as well. Financials. Now, this one actually looks pretty good. So we're holding those short-term moving averages. Financial stocks tend to do well when interest rates, or at least the long end of the curve, rises, as they have done, and overall interest rates are still historically very low, so that's supportive of this sector here. Happy to maintain holdings in that sector, whereas discretionary energy, I think you want to be a bit more cautious. The gold sector, I'm pretty bearish on gold. I didn't show you the gold chart, but let's do that now. We have had a big break of the key support level there at 1764. There's a little bit of support coming in around about that 1700 level, but failing that, it could be a long way to go. On the weekly chart, there's a bit of support from the moving averages around 1600, but 1450 could be the ultimate target, and there's every chance it could get there, especially if bond yields continue to rise, because gold doesn't like that. So a little bit cautious on gold stocks as well. Over to the healthcare sector, this one is just hanging on. It did break down last week on a weekly closing basis of a support level through here, and it's got back above it, but I still think the short-term trend is down and the long-term trend is under a great deal of pressure. The information technology sector has pulled back to its long-term support zone and bounced. It's just funny how that happens sometimes until we see a resumption of higher peaks and higher troughs. I'd be a little bit cautious, not sure why that's not drawing as it should. But I want to see something like that occur, because with this short-term downtrend in place, the alternative could be something like this, and then we would be in big trouble if that occurred through the bottom of the zone through here. The materials sector still looks quite strong. We know that much like those value stocks, the financial stocks do well, cyclical stocks do well, and that's this sector here. I've got a few interesting charts to look at a little later on for individual stocks. Property sector looks quite weak. I would avoid that one. Tends to do poorly when rates are rising. Staples, same sort of boat as the property trusts there, and the utilities also. They tend to be quite defensive sectors and negatively yield sensitive. And then telecommunications is neither here nor there. It's a little bit like the information technology sector, so on watch, but probably more on watch negative than positive at this stage. Okay, let's finish off with our stocks of interest. I've got just half a dozen stocks here you might want to take a closer look at. They're looking quite constructive on the chart, and already we can see some of the differences between the chart on screen and some of those less positive charts that I've discussed so far. We are holding this short-term trend really well. Bell Financial Group, it's one of those those companies in the XFJ. The short-term trend is clearly up, as I said, holding it well. Resistance coming in at 202, support at 185, long-term trend very much intact, and I think if it can break through this 202 level, then there's every reason why you'd want to get involved. If we zoom out a little bit, we can see we're at all-time high, so there are no psychological resistance levels above this. So break of 202, Bell Financial Group looks very good. This one is Base Resources, one of those small minerals explorers. Once we're talking about anything small, of course, they are higher risk. So make sure you take that into account when you're thinking about where it fits within your portfolio. But for what it's worth, we do have a nice short-term uptrend, a very well-established long-term uptrend. It's being respected nicely by the price action and breaking through the top of this trading range here at around about 32, pulling back a little to where there's probably going to be a little bit of support around here, but ultimately at 30, I think anything in this zone is still a buy zone. If it breaks through 33.5, then it could move quite quickly into probably 40 cents. And heading to the next one, which is Invictus Energy. Again, another one of those small mining companies, this time in oil and gas. And it has a well-established short-term uptrend, a well-established long-term uptrend. We can see we're pulling back to that short-term uptrend, which often acts as a dynamic support point where the price tends to bounce or trampoline off that light green zone. We're coming out of it with some really nice price action, actually, so a good solid bounce on a pretty dour day on the market. That's also quite impressive. I'd be happy to go in around here, assuming we get a close near the high. So probably just watch that one as we move into today's close, and assuming it's trading above 9 cents, I think that one looks pretty good. Into Japara Healthcare, a nice breakout of that 86 zone. Again, we want to see how it closes. We don't want to see it come all the way back on the breakout. That would indicate a potential false breakout, so that would be concerning. But assuming it closes above that old resistance level 86, that old level should act as support. So you can try and pick it back here if you're a bit of a bargain hunter around that sort of 85, 86 level. Otherwise, if it does close above 90 cents today, then I think you can go with it. Into the next one, which is John's Lyng Group. Wonderful short-term trend, wonderful long-term trend. You can see again that trampolining effect of that short-term trend. We're just had it through here, breaking out through the top end of the zone, and again, assuming that we can close above 358, that should act as a support level, and I don't think you need to chase it too hard. I think with the market a little bit softer at the moment, you can probably pick it up around that 360 level, but I think it would be good buying there to participate in what is a very strong trend. And when we zoom out to that weekly chart, we can see there's no further upside resistance. And we'll finish off with Sims Group. That's the metal recycler in the very strong material sector we did talk about before. We'll zoom out on this one. This one's not quite all blue sky, but there's a fair bit of upside until we get to those resistance levels around about 18. In the meantime, 1450 might be a little bit of a challenge for it. I think you can buy anywhere between the short-term uptrend zone here, sort of 1350 into 14 if you do get pullbacks on anticipation that we should get through that 1450 and then head into the 18 level. But a really nice short-term uptrend. It's doing all the right things, and a nice long-term uptrend as well. Let's head back to the presentation and finish off by reminding you that we have a bunch of other fantastic market news updates, and you can find them in our market news section of the website. If you'd like, you can follow me or Think Markets on Twitter. We have an Ask the Expert session coming up tomorrow where you can bring your portfolio along at 12 o'clock Sydney time. Make sure you do register on the webinar registration page, and I'll be able to discuss anything you'd like to talk about with respect to your portfolio or stocks of interest for you. A week later, we'll have the 3 stocks with dividends and growth webinar, where I'll try to do the impossible, find stocks that have great dividend yields and great growth prospects. And then on the 24th, we'll have how to create an investing plan. But we will squeeze and Ask the Experts in on the 17th between those 2 webinars. The disclaimer before I leave you today says that everything we've discussed is general advice. We are a regulated Australian broker. We do have some products that could see you lose more than your deposit, so it's important you read this disclaimer carefully, or give us a call if you have any further details. It's been a pleasure chatting with you today. Hopefully you got lots out of it. All the best for your trading. Until we catch up again, bye-bye for now.